Everyone. Going to take you through adjusting the books today, and we're going to do something a little bit different. I'm going to walk you through the note that we have, and the reason I'm doing that is this concept is not as obvious as some of the other things we've done. So I want to walk you through the note, and then we're going to do the first class example together. So you'll see the note that's available to you, but also I'm going to go to an exercise and walk you through how I would do that exercise. So let's get into adjusting the books. Some of the definitions maybe I'll go through quicker, but uh, so you'll see here, we're going to introduce adjusting the books and then some more financial statements and closing the books. And that's going to bring an end to something called the accounting cycle. So in your midterm, you did transactions, journals, ledgers, a trial balance, then you did the various financial statements. There are a few steps that are missing and we need to do them. One is adjusting the books. Then we are going to introduce an 8-column worksheet, which will build on the 6-column worksheet you've already learned about. And finally, we're going to close the books, and that's going to end our learning on accounting for a service business. We'll have a few other things to do in the course before we wrap it up. So let's get going. When we are adjusting the books, what we're doing is we are saying we have some accounts and those accounts have balances, but those balances are not accurate because something's happened to our business. There's been some activity that's taken place and we need to now update our books. We are going to see a new account called a prepaid expense, and this is going to confuse you because a prepaid expense is actually not an expense, it's an asset, which is weird because why would we then call it a prepaid expense? So let me walk you through this. A prepaid expense is something we pay for in advance. So before the iPhone and other forms of smartphones that we bought plans for, there were often things called prepaid phones. You can still do prepaid phones if you want, but it's not very common. So let's use the prepaid phone because it's probably the easiest one for you to understand. What you used to do is you used to have a phone, and then you would go and you would buy a certain amount of credits, call it $100. And then as you use the phone, so if you texted, checked your data, made a phone call, you would lose money from that $100 original value until you got to zero, and then you would load up your phone again. So you didn't have a monthly bill. What you had was you would pay this bill in advance essentially. You'd say, I want to buy $100 worth of phone stuff, and then as I use it, you can take it away. That's called a prepaid expense. What we've done is we've paid for our texts and our data and our phone calls and whatever else we're doing on our phone. We've paid for it in advance, and then we chip away at that balance. So let's use that $100 example. If you have a prepaid phone and you put $100 on it and then you never use it and you don't want to use the phone anymore and your friend says, I'll buy the phone from you, you would say, okay, I'll sell you the phone for 50 bucks, whatever, but I also have $100 in credit for a prepaid plan and I want to get that $100. So what you're going to do is you are going to sell that phone for that $100 credit. If you use $25 worth of that prepaid expense, then you'd have $75 worth and your friend would give you $75 for it because $25 is already an expense that was used. So in business, we see that in this course in two ways. We're not using prepaid phones, but we have something called prepaid rent, which is rent that we pay in advance. And we also have something called prepaid insurance, which is insurance that we pay for in advance. And then supplies, which we already use, is already a prepaid expense account. We've just never called it that. All right, so here's how it works. Let's say you do rent and you pay rent for the year. So on January 24th, we got super cheap rent because it's only $2,400. I'm using that because if we divide that by 12, that works out to $200 a month. So if you can find rent for $200 a month, my advice to you, snap it up. But in this case here, on January the 1st, we bought rent for the whole year and we paid $2,400. Doesn't mean that our rent in January is $2,400. It means our whole year's worth of rent is $2,400. So to calculate how much the monthly rent is, we simply divide 2,400 by 12 and it comes out to $200 a month. At the end of January, I will have used up 1/12 of that. So I will have now paid for 1/12 of my rent, and I will then have 2,400 minus $200, $2,200 left in my prepaid rent account. So this is how I calculate it, and then this is going to be my adjustment at the bottom here. So this adjustment here is what we're actually going to do. And we now have a rent expense of $200 because we actually used it for January. So it's no longer a prepaid expense or an asset because we've used it up. If we were to sell our business, we would say we have 11 months worth of rent left, and that rent is worth $2,200. I now have an actual expense of the business of $200, and I have prepaid rent less $200, so I'm going to credit that account. And I'll show you an example in just a sec. With our T accounts is what it would look like. I had $2,400. I used up $200 already. I now have $2,200 left, but that is now an expense of the business. So what will happen the next month is I'll have another $200 in expenses all the way to the end of December, and my prepaid rent account will be worth $0. So I'll show you an example of that in just a sec. And then you'll see, as you see here, our rent is going down and our rent expense is going up as the months go on. Insurance works the same, so we don't need to do an insurance example because it will work the same. Supplies are also a prepaid expense. We just don't say that at the start of the course, and they work the same. As we use supplies, our supplies expense will be affected. So in this case here, I bought some supplies for $500. During the month of July, I used $150 worth of it, so those supplies are now an expense to the business, and I don't have them in my business anymore. So in this case, we bought 500, used up 150. Our balance now is $350 worth of supplies, and the expense of the business was $150. So let's head over to our exercise real quick now, and I'll show you how to journalize this. All right, so let's start here. This is the type of journal you're going to see. So in the first example here, we had prepaid rent for $14,000 was left. The monthly rent is $2,000. So our prepaid rent is valued at $14,000. If rent is $2,000 a month, then we know what's happening is because this is June, we've already paid for January, February, March, April, and May, which is $10,000. So we would have had $24,000 in this example. Take away the 10 we've already used, we have 14 left. We now know that monthly rent is $2,000. So what we're going to do is we are going to have a rent expense for the month for $2,000, and that's going to bring down our prepaid rent by $2,000. The way we're going to journalize that is rent expense, forget about the PRs, $2,000, whoops, prepaid rent, $2,000, and then rent for the month of June. All right, so that's how you do it. So rent was $2,000. You just need to pay attention to the wording here. So in this case, your 12-month insurance policy was purchased for $1,200 at the beginning of the month. So we purchased that a while ago. We're not doing the journal entry for that. But if we want to figure out how much our insurance is per year, take $1,200 divided by 12, and that means each month we're going to have an insurance expense, of $100. And now we know that makes sense that the balance in prepaid insurance is $1,100 or 11 months worth of insurance. The adjusting entry will be insurance expense and then we know the debit and credit always has to be the same. So again, what I've done here is I have just updated my monthly adjustment, and now that prepaid insurance has a balance of $1,100. The final one is supplies. So it's saying here, again, read through your question. Supplies shows a balance of 1,000, but when we do inventory, it shows that we only have $300 left. So in this case here, we're doing the math a little bit different, but we're saying if there's only $300 left, I obviously used $700 worth of supplies, and that's now an expense to the business of $700. So the adjusting entry will be this, and it will be for $700. I'm going to do some color coding because I know that helps us in understanding as we finish this tutorial up. All right, so these are your adjusting entries. The purpose of our adjusting entries is just to update our accounts so that they are accurate. So for prepaid rent, these two numbers are your adjustments. And then these are the accounts that you're doing for them. Note in each and every case when we do adjustments, you are going to debit an expense and credit an asset. For prepaid insurance, these are your adjustments that go here. And then finally for supplies, the adjustment is how much did I use? I used $700. That is now an expense to the business. And there you be. Okay, so that is how you do adjusting entries. I do not expect you guys to get this right away. Watch this tutorial, work through your examples several times because this is getting into some confusing concepts now. Reach out if you have any questions. We'll do lots of examples, exercises, discussions as we go through this unit. All right, good luck everyone.